is understanding non-difficult is internal rate of return. Last session, we talk about accounting rate of return. We talk about payback method. Now, this session, we are talking about internal rate of return. Now, accounting rate of return or average rate of return is similar to the internal rate of return. This is another simplest method to calculate whether the investments I'm making they are profitable or whether I'm selecting the projects out of alternatives are good or bad. To summarize this method, what I can say is just to analyze how much profits are generated over my investment and more the profits, more the percentage of profits, I'm selecting that project. In simple terms, if I give money to A, B, C, and D people, and out of these four people, those who are giving me more interest, they are best people. So I should select the opportunity where the interest is higher, where the returns are higher. So in this method, we are selecting the projects based on rate of return. So here, importance is given to percentage I'm generating out of my profits. So let's discuss in detail. In this method, we decide growth of accounting or we calculate return on accounting for time value of money and providing a non-complex solution for selecting any project. In internal rate of return, we are trying to just understand how much are returns and then we compare project A, project B, project C. That's it. So the technical definition is internal rate of return is used as discounted method where cash flow of investment is studied against outflow of investment and by comparing both, we take a decision whether my investments are good or bad. I do ranking of my investments and find out which investment is good, which investment is bad, and why. So here, calculation of return percentage and then ranking if I have more projects or calculation of investments and then understanding what are different investments. Why IRR is important? Because in case of average rate of return, the time value of money is ignored. But in case of IRR, the time value of money is also considered. Number one. Number two, it is just showing flow over the money for time period. Third, it is not complex like net present value and other formulas. It is very simple and easy to understand. And fourth, it secures the interest of investor that they want higher returns. So basically, if I compare in this method, I'm just analyzing the time value returns and comparing with my investment. Now, what is the formula? Please ignore this whenever you see the formula. Even though it's a part of formula, ignore this part. Because when we see this part, we feel that it is something complex. But actually, the simple formula is cash flow, that is time value of money, divided by 1 minus internal rate of return, that is discounting rate of return, and power is to T. Here T means time period. So this is simple formula we have it. Now it looks complex when you see the formula, But when we work out, you will feel that it is very easy to understand. Let's give an example. My initial investment is 35,000. First year I received, sorry, first 2 years I received 15,000 as income, and then third and fourth year I received 10,000 as income. Now, for time being, ignore the PV factor. That calculation part I'll explain later. So, after time value, what I get is 3,700 at 12% and at 20%, 1,600. This means investment is giving me annual rate of 17.58%. So, if my investment is at 12% discounted rate and it is generating income like this, it is always welcome. Now, let me share with the other way. My investment is suppose 5,000. These are the year. This is revenue. So we calculate 1, 2, 3, 4, and 5 years. Suppose first year it is 700, second year it is 1200, then it is 1500, then it is 2800. I'll change some value. It is 1200, 1600, 2000, and then it is 1500. So what I do in initial methods, I will find out what is total return available, 9,100. What is my investment? 5,000. So I can claim in accounting rate of return this minus 5,000. So I'm getting 4,100. I'll just calculate the percentage. 4,000 divided by this into 100. So my accounting rate of return is, or ARR, is 82. So my answer is ARR at 82. If I go with the payback method, then this first 3 years, it makes 4,800. So as per this, my payback period is in fourth year, right? Now, as per IRR, what I add something is time value. So I add PV factor. Now, PV factor means what? When I'm investing this 5,000, I may receive this 5,000 at 10% rate of interest. Then, in such case, I have to find out what is PV factor for 10%. And then I multiply this. So When I try to find out PV factor at 10%, there are different formulas. For that, for example, for the 1 year, the PV factor is, I'll just copy for time being. So I have copied for the 5 years ready-made values for time being. So let them make some short so that it is convenient. Now these present value factors will give me time value. So in internal rate of return, what I'll do is first I'll multiply this value with year. So the next column will be revenue with the present value factor. So it is equal to PV factor into revenue. So it is in paisa, so I fill up with the 2 digits only. So this is my actual revenue. Even though I receive 1,200, but actual value of 1,200 will be only 1,090. So considering the same, I'll now take total. I will have to find the income. So I think there's some mistake happened here. Let me just check the value of PV factor because this cannot be the values. Okay. I have doubt about some values. So what we'll do is we do our same calculation. So when it is equal to 1 divided by 1.10, the first year value will be 9.9. For second year, I'll use 1 divided by into bracket 1.10 into 1.10. My value is 0.82. Let's calculate now. because this P factor value are wrong, I need to add here. Now let's calculate for third year. It is 1 divided by 1.10 into 1.10 into 1.10. Then I'll calculate for the fourth year. 1 divided by 0.10 into 1.10 into 1.10. So 3 years are done. 1.10. So 4 years are done. So it is. And now let's calculate for the fifth year. 1 divided by 1.10 into 1.10 into 1.10 into 1.10. Now why 1.10? Because I'll just illustrate the formula, then you will get clear. The 1, 2, 3, and 4 years are completed. So let's make it 5 years. And I'll just copy this value for the fifth year. Now the values which I'm getting will give me exact answer. So now if I take a total, it is 6,000 is my actual income. If I want to find profit, then this minus my investment, my profit will be this much. And if I calculate the percentage, so profit divided by investment into 100, it is actually 35%. So in this method, I calculate PV factor. Now for PV factor, the formula is PV factor is equal to 1 divided by 1 plus rate of interest divided by 100, and this bracket needs to be T. So time is there. So using this formula, I have calculated this PV factor issues. And this way, we calculate internal rate of return. So in this method, I follow the accounting rate of return. So this was the previous method. But only addition of PV factor will make it internal rate of return. Now, if you see, because of time value, instead of 9,100, which I was supposed to receive, I'm actually receiving 6,759.67. So my profit is only 35%, not 82%. Any doubts in this calculation part? This part, keep it pending. I'll explain. In this calculation, have you understood what is difference between accounting rate of return and the difference between internal rate of return? The difference is that we applied something called as PV factor. So when I apply PV factor, my revenue with present value is calculated, and this is nothing but the change. Let's go back to our PPT. So as I explained, it is two discount rates, one is positive and negative. So it use the formula of discounted cash flow and help us to get exact value. So this formula I used 1 divided by rate of return bracket is T. Now let's talk about why we should use internal rate of return. As I said, it is the best way to explain anything because it is just based on time value and time series and very simple. If I getting a profit, select that. If I'm making a loss, try to avoid that. And if I option A, B, C, and D, select the project which gives high returns. It is very similar to the accounting rate of return. The only difference is in this case, I add present value factor. Otherwise, everything remains same. So here, if I compare, when I compare internal rate of return with net present value combines depreciation and other calculations and it's very tedious. Whereas if I compare with return on investment, it is simple a percentage formula. But over the years, the percentage will change because the base for comparison will not be same. And in case of weighted cost of capital, the weightage I allocate to the capital is based on my choice. So if I feel it is not showing profit, I can change. So IRR is one of the robust methods which gives an idea to evaluate the projects and my available options. Now, there are certain limitations with IRR. Number one, it is very time sensitive. It talks about flow of cash over the period. It assumes that whatever income you're generating, you're retaining that income and you're keeping maximum part as a reinvestment. Third, when your scale of operation increases, your cost starts reducing. But this part is ignored by internal rate of return. Similarly, if any project is generating more than one inflow or more than one outflow, that is also not considered in internal rate of return. And hence, this formula has a limitation where multiple inflow and outflow is there. And if the management is in the mood of expansion, takeover, or issue of bonus shares, then that case, this calculation part will have a limitation. Practically, this method is used for prioritizing or ranking the investments. This ranking always helps to analyze and understand rationing of projects. Rationing means if I have five projects and less money, which project to be select, which not to be select, why to select, this everything will be given idea. So overall, internal rate of return is the simplest method to calculate rate of return and decide which project is good, which investment is good, which investment has ranking one, which project has ranking poor, and make a choice for ourselves. So this is about internal rate of return. If anyone had doubt, please put in chat box. I'll discuss. Otherwise, we'll go for the next one. Okay, so let me share the screen again. We covered the another method of discounting, that is internal rate of return. Now, next simplest method is called as profitability index method. As the name suggests, in this method, index option is used. Now, index means what? Suppose I have year 1, 2, 3, and 4. This first year will be considered the base year. Suppose this year I generate income of 100. This year I generate 200. This year I generate 250, and so on. So what I'll do, if 100 is here and 200 is here, it means index has changed by 100%. From 100 to 250, 3 years it is changed 150%. So I will find out based on index how much is returns available, and then I can take call about investments. So let's discuss in more detail. The capital budgeting technique that measures the value of project for helping prioritizing the investments is called capital indexing method. In this method, we try to provide alternatives where projects of different size having different cash outflow will justify initial cost based on the profitability generation capacity they have. Here, what may be their output is not important, but what is more important is to understand how much profitability they have. So, internal capacity is analyzed with the help of indexing. In profitability index, what we do is we calculate financial metrics, that is the relationship between present cash flow and future inflow. It measures profitability while comparing investment scales. So if I have investment of, suppose now, for example, here I given, if for 1 rupee invested project, my profit index is 1.25. What it means? It means if profit index is 1.25, then if I invest 1 rupee, my return will be 1 rupee into 1.25, that is 1 rupee 25 paise. So for 1 rupee, if I generate in 25 paise, then my returns will be 25%. Then why it is important capital budgeting? Because in this method, the least complications are involved. Like in payback method, I have to find out the period. In internal rate of return, I have to find out PV factors. But here, time value is already mentioned or the flow is given. I just need to compare the 2, 3, 4 years succession comparison, and then I will take a call which investment is good, which investment is bad, or which investment I should select and which I should not select. For this, it is always considered as a benchmark that at least 1% of profit should be there, that investments are good. Let's talk about calculation. There are two methods. One, in first formula, the present value of future cash flow divided by investment, I'll get profit index. And in second, when I use present profit index equal to 1 plus NPV divided by initial investment, I'll get it capital index. Now here, when present value is used, this is non-discounted. And when I'm using net present value, I'm applying PV factor. So When I'm applying PV factor, the formula has addition of 1. But when I'm not using present value, net present value or PV factor, then my formula remains same. So both the formulas are same. Only when I'm following NPV, the method changes. So luckily we have Excel sheet. So let's work out on Excel sheet and try to find out. So our formula is present value of future cash flow divided by initial investment. Now our formula is for this profit index is equal to present value of inflow divided by investment. And when I calculate here, my formula will be 1 plus NPV inflow divided by investment. So both the things are correct. If I find out here property index, then what I get is 6,000 divided by 5,000. I have to put this in bracket. So 1 plus what I get, that property index for NPV is 2.35%. So please see here, it is 35 and it's 2.35. So more identical. And in this method, if I calculate, it is 9,100 divided by 500. So it is 1.82. So if we just find out both the numbers, it is showing that 35 and 35. That is IRR and ARR both are matched. So formula is simple. Now this I'll do for the overall. Even I want for the first year, second year, same methods I'm using. Suppose first year I want the index to find out, then 1200 divided by 5000, it is 0.24, but here it is equal to 1 plus 1090.91 divided by 5000, it is 1 point, I'll make it 2 digits. Yes, so it is 1.22. So this way I need to find out profitability index. And this profitability index will give me an idea how I'm making the profits over the year. When I use NPV, I use the formula this 1 plus net inflow divided by investment. And when I use the present value, that is the normal returns, I use formula present value inflow divided by investment. If any doubt about this calculation, please put in chat box. Now let me again share the PPT. So I just illustrated. Now let's find out steps to calculate. First, I have to find out what is projected or estimated cash flow. Second, I have to find out what is my cost of investment. And then I have to find out what is return, that is discounted rate of return available. Now, when I say discounted rate of return, it typically means how much is percentage or what is the rate of investment I'm getting. Based on this, I have to find out the opportunity cost rates, and comparing all these rates, I have to decide what is my discount rate. Now, this discount rate will be for a calculation of present value factor. For our numerical, we assume 10%. It can be 5%, 12%, 20%, or 30%. Based on discounted rate, we have to find out PV factors. Now, this is the most clear idea about PV factors. So let's take an advantage and explain what is present value factor here. PV factor is equal to cash flow divided by 1 plus R power is to T. And when it is net present value, it is cash flow divided by 1 plus R by 100 power is to T. So this formula we just applied initially. When we are calculating any percentage, we always take cash flow as 1. So 1 divided by 1 plus rate of interest. Now when it is 10%, so suppose present value we are calculating, our rate of interest, our rate of interest is 10%. Time is 1. Then the formula becomes 1 divided by 1 plus 10 divided by 100 bracket raised to 1. So it is equal to 1 divided by 1 plus 0.10, and that is 1 divided by 1.10. Now please remember, this is for the 1 year. When I calculate it, and the answer will be something 0.909, what we are calculated in Excel sheet. But if it's for 2 years, suppose this value is for 2 years, then what I'm doing, I'll be writing here square. Then here it is again divided by 1.10. So 1.10 into 1.10, and this total I'll be dividing to 1. If it is for 3 years, then the value for the 3 years. If it is for 4 years, then value for the 4 years. So this way we calculate present value factor. Please read this formula. If any doubt, post it in chat box. So no posting. So I assume that things are clear. So let's go on for next. After calculating our present value factor, understanding discounted rate, we will add all the values calculated for present value, apply the P factor. After P factor, we take the total. Once we take the total, we'll divide the initial invest by, sorry, we divide it by our initial investments. In case our profit index is more than one, it is show profitable project. But if my profit index is less than one, it shows the project is giving negative returns. So profitability index gives a standard matrix that allows a direct comparison between different size, different duration projects. Here it is 5-year project or 10-year project. I'm not interested. I'm only interested whether the index is more than one. Okay, it's a profitable. If more than one, then how much is more than one? If it is 2.8, it is 3.4 or something. So higher the index, more great profits, more base the projects. So in this case, the higher projects with higher profit index, they are achieved. Let's talk about example. My investment is 1,50,000. The project is 7 years and discounted rate is 10%. This is 7 years cash flows given. I will just wait for 2 minutes. Please read the example given. Now let's talk about solution part. The normal formula is I get total index, that is my total income generated is 16 lakh 2,664 and investment is 15 lakh. So I get profit index 1.068. So it means my returns are 6.8%. When my profit index is more than one, like shown here, it is always an additional income generation. So the value creation is 6.8. Then based on investment, I can assume that 1,02,664 profit can be generated based on my inflow. So considering this, I can say project A is a profitable. Now, what are interpretations of profit index? The first benchmark is if it is more than one, accept the project because more than one, it shows profitability. If it is less than one or equal to one, it is always a risky project. If less than one, it means for 1 rupee investment, my outflow is generated less than one. In that case, you have to reject that project because you're not able to recover your investment. Whereas if my profit index is exactly equal to one or near about one, then this case project is only meeting the inflow equal to outflow. But there is no revenue generation, there is a poor generation of income. So in this case of projects, we are not going to accept for long term. Short term, this can be okay, but in long run, these projects will not help to meet the competition because in long run, I had to manage competitions, I had to manage change in product, I had to go with the innovations, I had to go with the expansions and forward backward integration, which is not helpful by this type of project. So this is not welcome in case of long run. So always would accept the decision when profitable index is more than one. Any doubt? Please read the rule once again. I'll wait for
Sir,
2 minutes.
sir,
Yes. Huh?
can you go back? Can you go back and please show me the example which you have taken now? Yes, yes. Sir, in this example, at for year
Mhm.
4, you have written here rupees 2 lakh.
Mhm. Mhm.
Hello.
Yeah, it is 2 lakhs.
Sir, in first year, there is 1,50,000.
Mhm.
Second year, it's 3 lakh.
See,
Third
it is
year,
not
5.
necessary. It is not necessary that your profit should go on increasing on same level. It may
Okay.
that 1 year I get higher inflow, second year inflow, third year might possible that due to some reason my inflow may be changed. So in
Yes, yes.
seventh year, it is 1 lakh.
Okay, okay. In seventh year, it
So
goes down.
it can go down because I launch the product, then people will start accepting the product. They feel product is good. So when my competitor understand ki, okay, people are interested in my product and this product has advantage, they start coming in my product. So the first thing I launch the product, I start getting revenue 1 lakh 50. Second year, people make demand and it goes on peak in the third year. Meantime, after my launching period duration, after 1 year, what I'm talking about, up to this, my competitor was not in tension. But he feels if I'm making a steady growth, he will try to introduce his product. So what happens here normally, my competition or government, they both come into act. Then when I reduce my profit from 5 lakhs to 2 lakhs, I become vigilant to what to do. My profits are coming down. Then again I change my marketing strategy, again I change marketing plan, and again I start earning profits. But after certain duration, the product become absolute. For
Got.
example, if I compare this with Maruti car if launched with suppose CNG, the other people will not have CNG cars, they will suffer loss. Then others will launch CNG, the market share will capture. Then something new is launched, it is there. After something new launched, it is there. So innovations and product modifications will give them profits. It is not necessary that ratio of profit will go on. Huh. Increase in profit consecutively, this is required in case of internal rate of return. This is required in case of your accounting rate of return. But for profit index, it is not required.
Yes, sir, got it.
Any person, any other doubt? So I repeat again, when my project is more than one, the 0.25, which is extra, because whenever I spend 100 rupees, I always should get 125 as a return. So if more than one, it means the extra is my profit. So I have to accept it is more than one. If equal to one, it means I spend 100 rupees and I received near about 100. It can be 101, it can be 99.99 or something. So near about 100. And here I invest 100 rupees and I received 85. So as a wise person, I will normally not accept this. This can be accepted for short run, but for long run, I'm not accepting this. And only this value, if more than one, I'm going to accept, because more than one means I'm getting profits. Now, what is the advantage of profitable index? This index is give me summary value. Now, if I have multiple projects of different period or different inflows, ranking for them will be difficult. But this will give me a common standardized format, because for this, how many is inflow is not relevant. It is important that inflow is generating profitability. As per this, the amount which I invested should generate more than that return. So I can compare multiple projects at the same time. Secondly, very easy to calculate. Third, it includes time value of money. If I'm not interested in time value of money, then I have alternate formula. So both the things are taken in consideration, and it gives a benchmark to recognize whether the project good or not. That is a more than one, less than one, or equal to one. So overall, using profitable index is the most comfortable compared to the accounting rate of return, compared to payback method, and so on, because the calculations are easy and recognition or understanding is simpler. So profitable index is more appropriate value in compared to the others. The most good thing about PI is, if I have project of 5 years and other project of 7 years, or other project of only 3 years inflow, then in all other methods I cannot compare them directly because duration is changing. But in PI I can directly compare and find out property index and just compare the property index. So variety of projects having multiple inflow and outflow is not making direct impact on PI. So it's very comfortable to understand and explain the comparison of multiple projects. Now, talk about limitations. This profit index, as the name suggests, sorry, as the name suggests, it only talks about profitability. It ignores other aspects about scale. It ignores the duration aspect. For the profitable index, generating more profits is important. Secondly, duration is ignored in profit index. How much profit I'm generating is more important. And third, this project is not involving other exclusive pricing or calculation, where the other values which are not related but adding to the cost of project, like social values, installations, or any cultural values, these are not added. The only interest is given that how much return I'm going to get over the period, and it is compared with the inflow. So the limitations are, it only talks about profits. It never takes in considerations other than profits. Second, it is time sensitivity factor is not so controlled in profit index, because 3 years project can be compared to 5 years, 5 years project can be compared for 2 years. In importance is how much profit I'm doing. So here profit index makes an different role. So in conclusion, profit index is one of the best alternatives to all other capital budgeting methods. It is very simple and easy to calculate. It covers present value factor also, and it covers normal cash outflows. As per this, investment outflow divided by investment value, if more than one, accepted, less than one, denied. So I can compare multiple projects. So today we talk about two methods, is internal rate of return and our profitability index. In case of internal rate of return, it is exactly parallel method to the accounting rate of return, but only the present value factor is added and then we calculate its rate of return. In profitability index, we find out whether the index is less than 1 or more than 1. The formula is used as inflow of cash divided by outflow of cash. It should be more than 1. In case of present value, we calculate as 1 plus inflow divided by outflow. So these two methods are done. Now we remain with the most important method, that is net present value, and then we'll be completing 3 units of our advanced financial management. We almost finished today evening the 4th unit of direct taxation. So if any doubts you are not able to ask, please post it on WhatsApp or email me. I'll solve your doubts. So that's all for today. If any doubts, you can just ask me or post in chat box. Or if no doubts, we can close the meeting. Thank you. So I'll just close the meeting and you can continue your work. Wish you a wonderful time. Good day.